October 17th, 2023. Today, from bar 6 to bar 11, we got a bull surprise. And when you get a bull surprise, particularly early in the day, oftentimes you're going to get a measured move up of the bull surprise. And that's exactly what we got today, from this low to this high, up. Some traders consider, this is a minor pullback, right? And 15 to 20 is a more complex pullback. So some traders will look at this as this is the first leg up, and then you get a complex pullback and then a second leg up. And if you look at it that way, it's still the same measured move to here. So regardless of if you were basing your, measured move projections off of this or off of the leg one, leg two, it still ended up about at this high. And, it's not uncommon to get a lot of profit taking at areas with a lot of measured moves. What I meant to say was, additionally, we went outside up. 70% of outside up days are going to close in their upper or lower third. So if it's an outside up day, 70% chance you close in the upper third. If it's an outside down day, 70% chance you close in the lower third. And today, you can see, was one of those days, part of the 30%, where we were not able to close in the upper third. For what it's worth, I think when you get something this strong, it's reasonable to expect a pullback and then a second leg. And you can see we got three pushes down, one pullback, two pullback, three, and an attempt at a reversal up, essentially a wedge on 46. But this was way too steep to be buying above 46. You should be thinking that this needs a second leg down. We might get an attempt at a second leg up later in the day, but you should ultimately be thinking that 46 is probably going to fail. And when you get 47, a breakout below the wedge attempt, you can, a lot of times look for a measured move down. Use that one, or you could use, the tail. Regardless, it brings you to about where we started to find profit taking down here. And that's, one of the magnets that traders were looking for. And that's why there was a lot of profit taking down here as well. I have some other examples of outside days. I actually think I put that in here, so there it is. But you can see this one closed in its lower third. This closed in its lower third. This closed in its lower third. This closed in its upper third. This one also closed in its lower third. This one did as well. There was one here that didn't. This one does not close in its lower third, and neither does today. And so we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 examples, and 8 of the 10 examples, obey the rule, and that's it's close enough, right? It's not going to be exact, but if once I have 100 examples, I'm sure it'll be exact. So bar one, bull bar closing near its high. It's a good bull bar. After a big gap down, if you get a good bull bar, it's okay to buy above, hoping, maybe there's a 30% chance that it's the low of the day and we're just going to rally. You have to pay attention to the prior day's low, because that's always an area where you're going to find profit taking. Bulls who bought below the day's low in the Globex session and buy more lower are expecting to be able to get out around break even on their first entry with profit on their second, and they're probably going to be able to. And if you look at what bar two does, so first off, if you bought above one, are you thrilled with bar two? Not really. Bar two is, kind of disappointing. It's a bull bar, but it's essentially a doji bar. And if you think a little deeper about what bar two did, bar one goes up, bar two goes down, and then bar two goes back up. And so it's essentially a high one buy and a two-legged correction. And when you think of spikes like this, oftentimes spikes are, you can just think of this gap as a spike is what I meant to say. So when you have a big gap like this, you can just think of this as a big bear bar. And when you get a big bear bar and a two-legged correction, you might have to get another leg down. So I don't think it's all that smart to be long above two. Occasionally you're going to get a surprise breakout up. But if you are long above two, you need to be pretty quick to get out when three starts to turn down. And the reality is it's not going to break out to the upside all that often. And this, if it was all that bullish, two would have started to race up. It wouldn't have, done this. So you shouldn't be as eager to get long after bar two. Bar three is disappointing. Sellers above two. Probably not much follow through to three after, consecutive bull bars. They're not very strong, but it's still consecutive bull bars. You can see on bar four, we went back and tested around the two close, and any bulls who were buying for any reason in here, disappointed at three, getting out around break even during four. 5, strong bear bar, but breaking to a new low on the day. The bulls who buy below one are probably going to make money, and you have tails on 3 and a tail on 4. So it went down on 3, up on 3, down on 4, up on 4, and then down on 5. So to me, I think of that as kind of a parabolic wedge on a smaller time frame. It probably is 940 to 950. Just go look at a 1 minute chart. It's probably some sort of wedge. Yeah, 1, 2, 3. So it's essentially a parabolic wedge on a smaller time frame. And I don't think 6 is a good buy, but I think, that makes you not want to sell 5 as much because this is potentially a wedge bottom. And so I would rather wait to see if we get follow through and a breakout through the wedge bottom. But reality is we're probably not going to. There are tails here, big tails on both sides here. We're probably going to be more sideways. Some follow through for 7 on the for the bulls, but I think all that 7 is bears who sold 5, disappointed 6, getting out around break even, causing 7. And then we get a big surprise on bar 8. The big surprise might be from bulls buying the close of 7, thinking that it's a pair of bull closes, and if we go lower, they're going to be able to scale in and make money. And if we race up, great. Could be bears in a panic covering shorts after a pair of bull closes. Could be both. It's probably a combination of both. It almost always is. But we get a big follow through bar on 8. And 8's really important because it makes the market clearly always in long. And when the market's clearly always in long, a lot of traders will buy above a bar like 8. Additionally, it's early in the day. And when it's early in the day, it's okay to take more chances because you don't really know what the day is going to look like. So when you get things like this late in the day, it's not as good of a sell for a lot of reasons. But early in the day, when you get big bars, it's more okay to take chances and hope that we end up seeing some sort of trend day because you don't know what the next 70 bars are going to look like. And there's a reasonable chance we get some sort of bull trend here. Follow through for the bulls on 9, and 9 did something really important. It did not overlap with the 3 high. So traders who sold above 3 and tried to scale in got trapped on 9. And so there's probably going to be bears buying back shorts at some point, and that's going to drive the market up higher. So when bears sell above this, and then you see this, and that they weren't able to get out of break even, that's extremely important. That tells you that they're trapped. Kind of a similar thing happened to bulls up here, by the way. 35, 36, not great by the closed bars because we're so overdone, but still by the closed bars. And bulls, even if you bought below 36, you can see they tried to get out of break even here, but they were never let out either, which is unusual. Tomorrow, for what it's worth, I think that we're kind of due for a rally. I think we'll probably gap up tomorrow because I think, bulls were trying to form some sort of essentially what was going on here this was a trend line break and a lower low in an attempt at a major trend reversal on 68, but it just didn't close strong enough and traders weren't all that interested in it. So I think we were trying to form some sort of major trend reversal here, but we failed to get a really strong one. So I think we're probably going to gap up tomorrow. And if we don't gap up and we gap down somewhere in here, I'm going to personally be looking for some sort of reversal up in this area to buy, because I think that we're going to get back to this low. And the reason that I think that's going to happen is because when you take a reasonable buy, like buying below 36 is a reasonable buy, you have an 80% chance to buy more lower above a bull bar and it'll get to the midpoint. So, you could argue any of these were reasonable bull bars, but we never quite got to the midpoint. So let's say we get a gap down tomorrow and we get a bull bar on like bar 5 or something, right? And it closes here. This is just completely hypothetical, but we get a bull bar closing here. There's an 80% chance we're going to get to that midpoint. So it's okay to take the swing buy. And there's a 60% chance we're going to get all the way back to that 36 low. So I do think that there's a reasonable enough chance if we gap down, we're going to get a rally tomorrow. And I think the 36 low is a pretty good profit target. It's a pretty far profit target as well. You're talking about like a 30, 40 point swing. But if there is some sort of gap tomorrow and it clearly becomes always in long, I'm going to be buying, looking for that low. So follow through for the bulls on 9 and 10. 11 is outside up. This is a decent enough spike. And again, a lot of traders will just look for a measured move up, like I already talked about. 12 is an attempt, to reverse the market, but it's really just probably a pullback. Some traders would argue it's one pullback and then up again and then down. So this was 2 legs up, but the reality is it's not strong enough to take any sort of sell below 12. You're better off buying below 12 or just doing nothing. 13, good bull bar. I think 13 is interesting because you have the open gap. Generally, when you have a spike and then an open gap, I like to try and buy the high 1 or add to my position if I'm already long. So it's reasonable to add above 13, hoping we get a little higher. 14, good follow through for the bulls. But I think that bears who sell above 11 are going to make money. 15, inside bar. I think always in bulls definitely can exit below 15. It's potentially two legs up, and bears might get some sort of follow through on 15, so it's not all that great. 16 is an outside bar, and it tests back to essentially the 14 close. So not as many traders exiting. 17 is an interesting bar as well. You can exit below 15, but you probably don't have to. But I think once you get 17, it can be a double top and it could be 3 pushes up. So I think you definitely have to exit below 17 if you're a bull. And bulls know that other bulls are going to be exiting below 17. And so what they'll do is they'll buy the close of 17, hoping that they're able to drive the market up and we don't, and it doesn't trigger. That's exactly what happens on 18. Bulls buy the close of 17 and we get a rally on 18. So the market never triggers to sell below 17, and thus those bulls are kept in. 18, so bull bar, but a lot of the bulls who are buying the close of 17 are just going to take the quick 5-point scalp that they got. 19, it's could be looked at as two legs down and then a high two above 19. I think it's maybe an okay swing trade. There's a 90% chance we're going to break out of the opening 18 bar range, so a lot of traders might take the buy. And I think 20 is a really interesting bar as well. 20 is essentially a failed breakout attempt of the 18 bar range, which happened on the tail of 20. And so a lot of traders would look to sell below 20 if it triggers and maybe get back to, to close this gap would be the initial profit target. But if you think about it, still 90% chance we're going to break out of the opening 18 bar range. And so if we get down to here, odds are we're probably going to get all the way down to here. So a lot of traders would sell below 20, hoping, initially that we're going to get somewhere down here, but really hoping that we're able to get all the way down below the 6th low. 21, bull bar closing near its high. It's 3 pushes sideways. And sideways to up, really, if you go from down here, you can see, the rally was pretty strong and the correction was extremely sideways and a little bit sideways to up. So pretty strong for the bulls. Still a reasonable chance we're going to continue up. I think it's a good swing buy above 21 if you exited for any reason in here, which I thought it was okay to get up below 15, but you just have to be ready to buy again. And I think buying above 21 is a great place to do that. And you get good follow through on 22. And additionally, buying above 21, it's helpful. Again, 90% chance for breaking out of the 18 bar range. Borderline 100% chance buying above 21 that we're going to go above this high. Maybe very, very occasionally you're going to get an outside down bar that traps you in. But I think if you buy above 21 and then you get an immediate outside down bar and you're trapped in, you're now a trapped bull. And there's lots of trap bulls, so you can reverse your position and you'll have the same premise as the bears who sold below 20. So I think 21 is an okay swing buy. You get good follow through on 22. 23, a little bit disappointing that it pulls back and lets the bears who sold the breakout out with a profit. So again, immediately not as strong as it could be. 24, inside bar. This is probably going to act as an inside pattern. It's not quite, obviously, but it's probably going to act that way. So you have to be pretty careful buying above like 24, in my opinion, because I think it could potentially be a final flag. So you want to see follow through, but I still think it's okay to be long, and you get good follow through on 25. Bulls who are long for any reason can now pull their stops below 23 because, every time you get a swing up to a new high, you can move your stop to the prior swing. So let's say you bought above 8 and you get this, and then you get good follow through and you get a close above the prior extreme. 11 is the prior extreme. You get a close above it on 14. Your stop can now go below 11. We go sideways, you get 21, you get good follow through on 22. Your stop can now go below 17. You get good follow through on 25. Your stop can now go below probably, 22 or 23. 26, 27, 28, more good follow through for the bulls, lots of bull bars. However, there are tails, and even on the strongest bull trend days, there's usually a couple hours of sideways trading. So odds are we are not going to rally all day. Additionally, on bar 28 now, all of these, all these bars are really strong, but what are the odds that we're really going to rally just for hours and hours? Like I said a second ago, even the strongest bull trend days are going to go sideways for a couple of hours. So, you start to get resistant to wanting to buy up here, and you get bad follow through on 29 and a good, a high one essentially on 30. It's not great, but it's theoretically reasonable. But I would be really quick to get out if you're buying above 30. And you get bad follow through on 31 and essentially doji to 32, 33. and a second attempt down 34. So none of this is all that great. And then you get 35, 36. And does it make sense that the market got weaker and then it just suddenly got stronger? Not really. 36 is a great looking bull bar, really deep in a bull trend. And what that tells me is that it's probably pretty climactic. And so when you get an outside down bar on 37 at, multiple measured moves, and, traders would argue this is an attempt at a bear flag. So 1, 2, 3, 4. So it's it's essentially a wedge after a bear flag at a lot of, wedge after a breakout of a bear flag at a lot of measured moves. To me, seems like really good idea to exit your longs below 37. And if it's a good idea to exit your longs below 37, it's probably a reasonable swing short. Notable that I think 37 is usually a minor reversal. This is rare. This doesn't usually happen, but bears do end up getting, not good follow through on 38, but an inside bar on 39. So you have 3 straight bear bars. Again, this is strong enough for a second leg. Reason being, look at a 15-minute chart. You have this really strong spike. This is probably strong enough that we're going to get another leg up at some point, which is part of the reason why I think we're going to rally tomorrow. Or we're going to, at least have some sort of rally tomorrow, is because this was really strong, and we got a deep pullback here, deeper than bulls wanted. But I still think we're going to test this close. So back to the 5-minute, big follow through on 40, but big tail on the bottom. 41, essentially a high 1, but not all that good. 42, outside down. And some follow through for the bears on 43. You can see bulls who bought below 41 could buy more lower, make money on 43. So it's not the strongest bear trend, but you have to keep in mind that the bulls who bought below 36 are trapped and have been trapped and are still trapped. So I think that but by 41, it's a tight channel, right? It's a pretty tight channel for the bears. So there's a reasonable enough chance that we're going to go a decent bit lower. And even if we start to rally, this will probably get a second leg before we get any sort of major reversal. 45, inside bar, low 1 short, tight channel. So probably okay, but it's not all that great. It's 1, 2, you're selling a third push down. So we might have to get a reversal up pretty soon. And we do get the reversal up on 46. And then we get outside down on 47. Like I mentioned, attempt to break out below the bull flag, and bad follow through on 48. So bulls bought the close of 47. Bulls who bought below 46 bought more lower, able to make money. So bad follow through on 48, but then essentially give up bar on 49. Bulls started to exit. They realized that there are bulls who will start to scale in here, thinking that we're going to end up getting a rally. And to me, they're starting to give up down here, thinking that that this is a tight channel, definitely good enough for a second leg. So a lot of bulls will start to give up, and that's what causes 49. 50, inside bar, like I said, maybe okay to sell below 50, some sort of low 1 short. Bad follow through on 51. 52, tails on all these bars, and then you get 53. And 53 is a breakout below the bear channel. Whenever you get a breakout below a bear channel, only a 25% chance that you're going to get major follow through on it. And you can see that's why, not surprisingly, we got bad follow through on 54. Inside bar on 55 and high 1 on 50, or I guess high second attempt at a reversal. First attempt here, second attempt reversal on 56. Bad follow through on 57 and big bear bar on 58. At this point in the day, around 58, I was kind of thinking that it's possible that we kind of get vacuumed down to the 3 high. Logic being, this is a trading range day, and in a trading range day, gaps might be close. Sorry about that. So I thought there was a reasonable chance that we were going to get vacuumed down to the 3 high. I think that's what was trying to go on here, but the bull argument is that this was a bear trend line break, lower low, major trend reversal attempt. And I think the bear argument here was that we're trying to get to the 3 high, and this deserved a second leg down. So it's 1, pullback 2, and 65 ends up being a second leg trap. But you can see on 58, I kind of thought that might be the start of a move down to here, and it never triggered. And so when you get bad follow through like that, you have to start to wonder, what are we going to end up doing here? This is, bad trading. This is a tight trading range. And when you see 62, I think 62 is an interesting bar. Brad from the trading room likes to talk about swing trading as fishing, which I think is a really good analogy. when you're buying, you're kind of just fishing, hoping that you're throwing your line out, hoping that you're gonna catch a big swing really quickly. And I think 62 is one of those bars where you can take the buy, hoping that we're going to get a measured move up of the flag and maybe get back to the 48 low, since bulls bought there and they weren't able to get out of break even. It's a trading range day, so you can see magnets to the upside and magnets to the downside. So it becomes kind of a question more of what are we going to get to. And I think you can buy above 62, but then when you see 63, you have to get out. I mean, if you bought above 62, your premise is that we're probably going to race up to the 48 low, and then from there, we'll see what happens. Basically, maybe if you're super lucky, we'll get all the way back up here or to this low, but probably not. But your premise, if you're buying above 62, is that we're going to get to this 48 low, and then you get bad follow through on 63. And a really good trader would get out as 63 is starting to go down, or you could get out below 63 as well and take a small loss. And you're going to lose on this trade somewhat often, but it's going to rally enough times that it's definitely going to make up for the small losses. What you can't do is sit in the trade and take a full loss on 65. That's a really bad idea, because you're just not going to win this trade enough times out of 10 to make that profitable. So bad follow through 63, and 64 starts to rally, but disappointing close. And any bulls who are front running this rally, hoping that we're going to get a strong bull bar closing near its high on 64, they were thinking the traders who bought above 62 are disappointed in 63. And if they can get 64 to close on its high, all the traders who exited will think that they're trapped out of a trade, and they'll buy above this. And the bulls who front ran this are going to make a lot of money. However, 64 is a disappointing close. And when 64 is a disappointing close, the bulls, they know that other bulls aren't going to be as interested anymore. So they all give up. And that's what causes a big bear bar on 65. And it trades below this low. You know that bulls who buy below 54 are probably going to make money. You can see they're able to on 66. 66, 67, we get an inside bar. I think kind of similar, could act as an II, even though it's not. And the moral of the story is probably a final flag on 66 and 67. Big bull bar on 68. Bulls who bought below 64 probably going to be able to scale in and make money. So 68 testing that 64 low. And again, 68 bulls. If you get a strong bull bar closing near its high here, I think bulls can buy for a swing, hoping that we're going to start to rally to the 48 low at least and potentially go higher. But it's a disappointing close. And when, bulls shouldn't be disappointing traders this much if we're going to end up rallying. So that's why you get bad follow through on 69 and 70. To make matters worse, 70 trades below 69. So this could be some sort of second leg trap up here. 71, bad follow through, and 72, essentially 3 pushes up. And then 73, a big outside down bar, or not that big, and actually not technically outside down, but I think it'll act as an outside down bar, closing near its low. I think of it, it's okay. It's an okay swing sell, but what are you thinking about when you see 74? 74 is not the follow through you wanted. You wanted better follow through. If you're selling below 73, your initial premise should be we're getting to the 67 high. And potentially, if you're lucky, we'll get vacuumed down to here. But you're thinking we're at least going to get here pretty quickly. And when you get bad follow through on 74, a lot of those traders are disappointed. They start to buy back shorts. And any trader who stays in sees 75, disappointed. And then they see 76. And a lot of those, any trader who sold and sees 76 is going to get above 76, because there should be no bull bars if you're selling below 73. Me personally, I would get out after 74. But if you're selling below 73, there should be no bull bars. We should head right to here or here. And when you get a doji bar, that's a problem. And if you decide to stay in, this just looks like a two-legged correction now. 1, pullback 2. And so you have to exit above 76. And that's what drives the market up on 77, 78. And then the end of the day. For always in, maybe always in long above 1, but why are we getting bad follow through? The first clear always in direction was above 8. And I think those bulls can exit below 15 and buy again above 21. I think always in bulls exit below 37. It's a reasonable swing sell below 37, but I think it's probably minor. This is unusual, but it's still reasonable to sell below 37, hoping for at least a minor reversal. I think it stayed always in short. Bulls were trying to flip it on 62, but not able. I don't think it ever clearly went back to always in long. Always in bears probably exit above 56 and maybe sell again below here, but they're exiting above there. So if you traded the always in, you probably, very literally, you probably did very well today, where you just buy above this and then sell below that, and you had a great day. On the daily chart, we're very sideways. I think we're going to probably continue to be sideways. This is a tight trading range, and outside up day, but not closing very strong. So I think we're going to continue to go sideways here. Like I've been saying, I think we're probably ultimately, going to go a little higher, but we might have to pull back first and before we get a second leg up. And we can pull back as deep as here. I don't think we're quite going to pull back all the way to here, but we could pull back as deep as here before this gets a second leg up. The weekly chart, bulls trying to get a rally, I think up to the low of the week of 9/11. That's probably what bulls are initially looking for. But you get one, pull back two, so could be just a two-legged trap. So probably not going to get a huge rally.